Cash flow is about the movement of money into and out of a business over time. It is not the same as profit. Profit is the final result at the end of a period. Cash flow is what happens along the way. A useful way to think about this is with a car endurance race. You might enter the most powerful, best engineered car on the track. On paper, it should win. But if that car runs out of fuel halfway through the race, it will never reach the finish line or collect the prize money. Its performance on paper doesn't matter if it can't keep going. The same idea applies to businesses. Imagine a company that sells smoothies to the biggest supermarkets in the country. The value of its sales is $7 million. On the surface, that sounds like a hugely successful business, but those supermarkets might take 120 days to pay. In the meantime, the business still has to pay its workers, its suppliers, and its running costs. If the monthly wage bill alone is $500,000, the business needs enough cash in the bank to cover those costs for several months before any money comes in. If it doesn't, workers may leave for jobs where they are paid on time, suppliers may stop delivering, and the business can fail despite appearing profitable. This is why profit is not the same as cash flow. Profit tells you how successful a business is at the end of a period. Cash flow determines whether the business can survive long enough to get there. A business might be profitable overall, but still struggle if cash is not available at the right time. For example, a business may sell a large number of goods, but if customers pay late, the business may not have enough cash to pay wages, rent, or suppliers when those payments are due. Cash inflows are the money coming into the business. This includes cash sales, payments from customers, and money from loans or investments. Cash outflows are the money leaving the business, such as wages, rent, utility bills, loan repayments, and payments to suppliers. Problems occur when cash outflows happen before cash inflows. Wages are usually paid monthly. Rent is often paid in advance. Suppliers may want payment quickly. If customers are slow to pay, the business can run out of cash even if sales look strong. This is why you'll often hear the phrase that profitable businesses can still fail. Without good cash flow management, a business cannot survive. Cash is needed to pay workers, keep the lights on, and continue operating day to day. In GCSE and IGCSE Business exams, cash flow often appears in questions about business failure or survival. A business with poor cash flow may struggle to meet short-term commitments, damage relationships with suppliers, or be forced to borrow more money, increasing risk even further. So when you step back and look at all three ideas together, they form a clear story. Businesses spend money on running costs and long-term assets. They raise finance from internal or external sources to fund that spending. But ultimately, success depends on whether cash is available at the right time. If you understand that story and what money is spent on, where it comes from, and how it moves, you're already thinking like an examiner, not just a student. If you found this helpful, hit like and subscribe so you don't miss the next part in our finance series.